These are the three ways that money can flow into a REIT. So through equities, through bank loans, as well as through bonds. Right, and then with the money collected, the REIT managers, they will use the money to buy properties to form up the portfolio. So depending on which sector the REIT is operating in, so the property purchase will be for office buildings, shopping malls, industrial assets, data center, hospital, hotels, or event centers. And the role of the REIT manager will also include financial planning. So they'll need to plan how much to spend, say for engaging security for the asset, or maybe for repairs, or also to do property enhancement. They also need to do up the finances for the shareholder meetings, the half-yearly report, and the yearly reports. They also meet up with shareholder during the meetings, and they will need to clear up clarifications clear up any questions that shareholders may have during the meetings. They also need to make sure that they comply with regulations, fire safety, the weight load for every levels. And also, they are also involved very much in the day-to-day management of the property. So this will involve things like the cleanliness of the asset, the safety of the assets, whether everything is functioning, the lifts, the elevators. And there's also a very human aspect to it. They have to also manage the tenants. Also, they have to acquire tenants, make sure they clear up any challenges that the tenant may face to help them to operate within the properties. And then when the lease is expiring, they need to approach a tenant to negotiate for renewals. And because of this very active role that they play, the REIT will pay the REIT managers a management fee, and this usually comprises of a base fee as well as a performance component to incentivize the REIT manager to improve the yield on the properties. So because of this involvement of a management team, so we also call REITs a professionally managed investment. Another party involved is the trustee. So the role of the trustee is simpler. So they are the legal owner of the properties, and they perform a custodian role. They also support the shareholders in check and balance on the manager. And they'll collect a trustee fee for their services. So when we invest into REIT, naturally we want to just have income from our investment. So with the property being leased out, we'll collect a rental income or occupancy income in the case of an event center or hotels. And before any money is paid out, we will need to first pay external expenses. For example, if you engage an external security company or cleaning company, you need to do the payment first, also payment for utilities. And after that, the money doesn't go back yet to the REIT holders. We will first have to pay the banks, because remember, we also utilize a lot of the bank loan in this REIT. So we have to do the loan repayment to the banks. And then we also have to pay coupons if we have issued bonds. So we have to pay coupons to the bond holders. And if the bond is nearing maturity, we will also need to prepare money for the principal sum repayment or to redeem the bonds. And bondholders who do not wish to hold the bond to maturity, they can also sell the bond in the market. So this is one way that the bond investor, they can get money back from the REIT. And for a REIT unit holders. Okay, the money that we will collect back will be usually from dividends, also sometimes from bonus shares, if the REIT issues any bonus share. Right, and if we do not wish to wait for the dividend, we can also sell the share to exit our investment. Right, so this is the overview of the REIT. Okay, so what are the reasons to buy Singapore REITs or S-REITs, or as we call them? So one reason is the low barrier of entry compared to investing in physical property. Okay, so usually REIT investors, we come in because we want to invest in property. So with through REITs, we can do our investment with very much less capital outlay. And then it also allows for us to buy into the position or exit our position very easily. All we need to do is have a stock account. And there's less legal requirement. All you need to do is just make sure you are eligible to open a stocks account. Then you can invest in REITs. And there's almost no paperwork involved when we are buying or selling REITs, or you just go online to say Poems, and then just do your buying or selling. And the cost involved to do the investment is also much lower compared to the commission paid if you're buying physical properties. So reinvesting also is property investing with less hassle. So because we have a team of professional managers to come and manage the property for us, so we don't have to worry about say fire safety or insurance or the maintenance of the property. Right, and then also through reinvesting, because of the structure for Singapore REITs, we almost don't need to pay any tax. And through REITs, we also get access to more varied asset types. For example, traditionally, individuals, when we buy physical property, we don't buy say hotels or shopping malls or hospital or event centers. But through REITs, all these investment asset classes are accessible for us. And then also through REITs, we can get easy access to very high grade properties. For example, a prime office asset in CBD, or a prime shopping mall in Orchard. So all these are very accessible through REITs. And also when you invest in REIT, you get instant diversification for your investment. Not just across property units, but also across asset segments and also geography. Because most REITs nowadays are invested not just in one country, but they will look across all regions for acquisition. So what are some factors that are favorable for REIT investing? Because as with any investment, we want to make sure the environment is favorable before we do our investing. So one very important trend is that the interest rates are expected to come down in the coming quarters. So the US Federal Reserve is expected to start interest rate cuts from September next week. So this could have some impact on REITs. And why do we say so? Okay, why does US interest rate affect Singapore REITs? Okay, one reason is because if we look at this chart, the chart on the left shows the US interest rates, and the chart on the right shows the Singapore interest rates. So we can see the interest rate profile for the two regions are almost identical. The only difference will be in terms of the absolute height. So in the US, interest rate is increased to 5.25%. Whereas for Singapore, the highest interest rate was around 3.6%. But other than that, we can see in terms of the time frame or the shape of the profile is almost identical. So as the interest rate in the US comes down, then we can expect the interest rate in Singapore to be lowered gradually as well. So what are some benefits of a lower interest rate on Singapore REITs? Okay, one is that the immediate benefit is that it immediately lowers the cost of borrowing. Because as we mentioned earlier, REITs are very dependent on bank loans. So with a lower interest rate environment, the REITs will be able to borrow at a lower rate. But of course, this doesn't happen instantly because usually the bank loans that the REIT undertakes is spaced out across many years. So only when the bank loan expire, then the REIT can look into refinancing. But this will have the effect of lowering the weighted average cost of debt for the REIT. Another benefit is that it will immediately lower the interest expense. So on a month-to-month basis, the REIT will need to pay less interest expense. So for the mid to longer term, this will affect the interest coverage ratio as well as lower the total expense paid out by the REIT. And then with lower expenses, then there'll be more money left over for distribution. So this could result in more dividends. But we don't just look at the direct benefit of lower interest rate. We also look at indirect benefits. Okay, one indirect benefit will be that it will create an easier operating environment for the tenants of the REIT as well. So if you imagine a retail REIT, shopping malls, then the tenant of the mall, because they will usually also have bank loans to operate the business. So if they can refinance their loans at a lower rate, then it'll be easier for them to be profitable. And similarly for the customer of the tenants of the REIT, say the shoppers. Okay, shoppers as individual, we also have bank loans. So if we don't need to pay interest charges for so much interest charges for loans, then we will have more disposable income to spend. Also, this will also benefit the tenants. And overall, all this very favorable environment will allow the tenant to be more acceptive for rental reversion upwards. And a lower interest rate environment can also create more opportunity for yield accretive acquisition. Because as the REIT look to expand their portfolio, they'll be looking to do acquisition. And then if the interest rate is lower, it'd be easier for them to consider the purchase, and also financially, the purchase could also be yield accretive. And also, the REIT make money not just through rental income, as we mentioned, the REIT can also make money through property sales. So a lower interest rate environment could create the space for the REIT to have more bidders for their properties. So in this way, they'll be able to get a higher chance to sell their property at a higher price. One thing to note, however, is that the benefits of lower interest rate will take time to flow through to REITs. Because, as we mentioned earlier, the loans of the REITs are usually staggered. Also meaning the loans don't expire all together all at once. And the REITs can only do refinancing when there's no when the loan is not subject to any penalties. So all this will take time for the REIT to gradually shift to lower interest loans. So as the higher interest loan expire, then the REITs will take up the lower interest loans. And then similarly for the contract with tenants, this reversion of rental will also take time because the REIT managers, they can only approach the tenant to sign a new contract as the lease expire. And another uncertainty that we have is that there'll be a new US president in November. So this could be either Harris or Trump. And either of them could also introduce inflationary policies. And if they do introduce an inflationary policy, then there could be price pressure upwards. And this could mean the Fed will have less space or to maneuver towards a lower interest rate. And then this also means that we could stay in a higher for longer interest rate environment after the new president comes on board. Okay, so we have completed the first factor for that favors REIT, the expectation that interest rate will be trending down. Okay, another factor that could favor S-REIT will be the tax sell down in the US, right? So starting August, we are seeing the fervor for AI stock and tech stock waning. And then we are also seeing the stock market performance moving towards a more income yielding instrument, or for example, the financial stocks. And then also the bond markets are doing well. And similarly, some money is also flowing into REITs. And another factor that is favoring S-REIT is the Singapore government support. So the Singapore government wants to develop Singapore into a global REIT hub. So they have very favorable tax policies. So if a REIT has at least 90% of the income earned distributed within the same year, then they don't need to pay any tax. And just recently in July, MAS proposed an amendment to ease the leverage requirements. So currently, a REIT will need to have an interest cover ratio of 2.5% to increase the gearing from 45% to 50%. But this will be lowered to only 1.5%. And with this amendment, REITs will find it easier to increase their financing, and this will make them consider acquisitions more favorably. Okay, so earlier we talked about factors that could benefit REITs in general, but why Singapore REITs specifically? Okay, the reason is because comparison with region, Singapore has many advantages. For example, Singapore has the largest REIT market in Asia, if we exclude Japan. And our average dividend yield is about 5 to 8%. On a comparable basis, if we look at not just dividend, but also the volatility combination, Singapore ranks favorably. And this chart illustrates that. So over here, we have the two REIT index, the IH S-REIT index, as well as the FTSE ST REIT index. So dividend yield is about 6%, and volatility is less than 12%. In contrast, if we look at Hang Seng REIT index here on the right, although the dividend yield is higher, around 9 to 10%, but the Volatility is also very high, or more than 27%. Also, this means that in the event of a sell down, usually the sell down in the Hong Kong REIT is deeper. And if you compare to the US REIT market and Aussie REIT market, the dividend yield is lower, but the volatility is higher. Same for the Tokyo REIT index. They have a comparable dividend yield, but at a higher volatility. Okay. This is the chart showing the dividend yield by sector. Currently, there are 7 sectors in the REIT: healthcare, data center, retail, industrial, hospitality, and office. Of the 7 sectors, the office REIT are yielding the highest dividend, whereas the more defensive sector like healthcare and the very future-proof sector for data center, they are yielding lower dividends. Okay, so we'll do our S-REIT picks by sectors. So we take a look first at retail. Okay, for retail, the REITs will be concerned with shopping malls. They will just look only at shopping malls. And the drivers for retail REITs will be tenant sales. And tenant sales, of course, the performance of a retail REIT, if the tenants are not doing well, then the retail REIT will also not do well. And tenant sales is very dependent on shopper traffic, consumer sentiments, and consumer spendings. And if the asset is in a tourist location, then tourist arrival, tourist spending will also be important. Currently, there are 7 retail REITs listed. So by retail REITs, we are referring to 100% retail. Also, meaning within this REIT, there's no other there's no property from other asset classes like offices. Also, that's why Capital Integrated Commercial Trust is not inside, although they have shopping malls as well. Yeah, so for this retail sector, my pick will be for Fraser Centrepoint Trust. Okay, the properties within Fraser Centrepoint Trust are all 100% within Singapore. And they own 9 shopping malls, and all are in very prime suburban location. For example, Next is in Serangoon, just next to Serangoon MRT, Waterway Point next to Punggol MRT, Hougang Mall next to Hougang MRT, Causeway Point next to Woodlands MRT, North Point City next to Yishun MRT, Tampines and Century Square, Tampines MRT, White Sand is Pasir Ris MRT, and Tiong Bahru is Tiong Bahru MRT. Right. So they are all in very prime location and very populous township. So this is the map showing all the location. They're mainly in the north, northeast, east, and central, and none in the west. So there's this survey of there's this ranking of the top 10 suburban malls in Singapore, and Fraser Centrepoint Trust owns 4 out of the 10, or next North Point, Causeway Point, and Waterway Point. And the sponsor is a Fraser Property, because it's very important when we look at REITs, we also look at the sponsor. And then the portfolio occupancy is almost 100%, 99.7. And then the portfolio yield is 1.97 yield. Aggregate leverage is less than 40%, which is what we want to look for. Interest cover is more than 3 times, 3.26. Weighted average cost of debt, 4.2%. Dividend yield, 5.35%. So what I like about this REIT is that all its property are located next to shopping malls. Sorry, next to MRT station and also in very populous towns. Yeah. Right. So for retail REIT, the stock pick will be for Fraser Centrepoint Trust. And for the office sector, the office REIT will be concerned with office buildings. And factors driving this REIT will be business activity as well as the employment landscape. Presently, there are 5 office REIT listed, and only one has Singapore office properties, or the rest are all 100% foreign properties. So the pick for this sector will be for Keppel REIT. The reason is because they have a big portion of the asset in Singapore. And if you were to look at these 4 properties, they are in very good location. Marina Bay Financial Center, One Raffles Quay, Ocean Financial Center, as well as Keppel Bay next to VivoCity. Here are the pictures of the 4 buildings owned by Keppel REIT. And these are the foreign properties owned by Keppel REIT in Sydney, Australia, Melbourne, Perth, Seoul, and Tokyo. And if you were to look at the matrix, the portfolio occupancy is 96%. Aggregate leverage is above 40, but not excessively so. So we can still accept this. And then interest cover is about 2.8 times. Cost of debt is about 3.3%. Dividend yield is quite high, 6.9%, because overall the market is slightly worried about office REIT due to the slow return to office after COVID that's observed in some countries. And but in Singapore, the situation is quite okay because Singaporeans generally are more obedient. Also, we usually, when the company say come back to office, then we will come back to office. So the demand for Grade A office space in Singapore is still quite resilient, which is why for this sector, the pick is for Keppel REIT because it is the only one that has Singapore mix in it. And for the third sector, the industrial REIT, they are concerned with factories, warehouses, distribution center, and then also science-related facility or bioscience, biomedical-related facility. So the drivers for this sector will be manufacturing and trade activity, and also in more recent years, e-commerce activity, because e-commerce will utilize a lot of the logistic and distribution centers. And then also bioscience activity will also play a part if the space is for biomedical users. And there are 6 industrial REITs or 100% industrial, and only one is all in Singapore. The rest are either a mix of Singapore and foreign or 100% foreign properties. For this sector, I will not choose the one that is 100% Singapore. Rather, I will choose Mapletree, the 2 Mapletree REITs, Mapletree Logistic, as well as Mapletree Industrial. So we take a look first at Mapletree Logistic. Right. Mapletree Logistics has 188 properties in 9 countries, but only about 20% is in Singapore. The rest of it, the biggest component is in Hong Kong, 23%. China is about 19%. Japan, 13%. So for logistic properties is more diverse. And one reason the percentage for Singapore is not as big compared to other sector is because of the lack of space in Singapore. Because Singapore is a very land scarce country, and logistic facility require big spaces or big land space. So we don't have a lot of that in Singapore, which is why many of the logistic assets are located in bigger countries such as China, Japan, Australia, where they can really build very big facilities. And the metrics are also looking good. Portfolio occupancy at 95%. Aggregate ratio below 40%. Interest cover 3.6. Dividend yield is 6.88%. And Mapletree Logistics also has a credit rating of a BBB plus or by Fitch. And how do we differentiate between logistic and industrial? Because this is one common confusion, because they are quite similar. So to differentiate them, what you can you can try to visualize a logistic property as very big spanning distribution center where there's a lot of container trucks accessing the facility, right? And those in Singapore are not so flat. Okay, they are usually built up to utilize the space. Whereas for industrial property, usually these will resemble more of factories such as those in Kallang Basin, or maybe data centers, or these shiny buildings, these are data center or high-tech parks. So also we don't see a lot of container trucks at this facility. So this could be one way to help you visualize the difference between logistic and industrial sectors. Right. Okay. So our next pick for this sector will be for Mapletree Industrial, and they have 140 properties in 3 countries. Most of it is a data center, more than 50%, and these are mostly in the US. And Mapletree Industrial Trust also has a big percentage in high-tech building. So we see the industry that they are involved in is more leaning towards tech and data center. Portfolio occupancy is 91%. Aggregate leverage is about 39%. Interest cover 4.3 times. Dividend yield is 6%. And they have a credit rating of BBB plus by Fitch. When we talk about Mapletree Industrial Trust, there's this memory of what happened in 2023 with this very big news on their 4th biggest tenant, Sistera. So Sistera filed for bankruptcy in June 2023. And the good thing is that although they are the 4th largest tenant, they only account for 3% of the gross rental income. And also, as the month progressed, there was a positive development. By November of 2023, Sistera was acquired by Brookfield Infrastructure, another company, and then Brookfield took over Sistera's leases. So in a way, this helped to mitigate losses for Mapletree Industrial. And so for this sector, the stock pick will be for Mapletree Logistics and Mapletree Industrial Trust. Right. Next, we look at data center. So for data center, the REIT will be concerned with data storage properties. And the drivers will be on the development of the tech sector, how much of the corporates are migrating to cloud, for example. Right. So there are only two data center REIT listed on the Singapore Exchange, Keppel DC REIT, which has a mix of Singapore and foreign property, and Digital Core, which is 100% located outside of Singapore. So for this sector, the pick will be for Keppel DC REIT. They have 53% of their property in Singapore, and the rest of it is across the Asia Pacific region as well as in Europe. For Keppel DC REIT, the occupancy rate is very high, 97%. Aggregate ratio is 35%. Interest cover also well exceed 3 times. And dividend yield, but dividend yield is very low, 4.55% only. This is because data center, this REIT is generally very popular with shareholders. So shareholders are willing to buy at a higher price for this REIT and forego a bit of the gains from dividends. And also another positive note for Keppel DC REIT is that although Sistera was also a tenant within the property, but Sistera only accounted for 2% of the total revenue. So they did not, they took a hit, but then it was also recovered after that. So for this sector, the pick will be for Keppel DC REIT. And then for the fifth sector, hospitality. So for hospitality REIT, we'll be looking at hotels traditionally, but then increasingly hospitality REITs are also looking towards other lodging facility or including service apartments and student accommodation. So hospitality REITs will be driven by tourism and business travel. And if they are offering student accommodation, then they're also affected by the developments in the education sector, or whether, say, a country, if they start to build a new university, or if the university in a country decide to increase their intake or decrease their intake of students, this will affect hospitality REITs that offer student accommodations. And also business travel, this will affect business activity and employment. This will affect the service apartment. So there are 5 hospitality REITs currently. Far East, all of their properties are in Singapore. And then for the rest, is mostly international properties. Right, and then from this sector, the pick will be for CapitaLand Escort. They have 102 properties in 16 countries. More than half are in Asia Pacific. 1/4 is in Europe, and 20% is in US. And the interesting thing about this REIT is that they are not the only REIT within these 5 that extend the facility to service apartment as well as student accommodation and rental housing. So the occupancy rate is also very good, 75% for hotels, and more than 90% for their longer stay lodgings. Aggregate ratio is less than 40%, and interest cover is 3.7 times. The REIT has recently sold down, so dividend yield currently is quite high at 7.64%. And due to this unique mix of service apartment and longer stay accommodation within CapitaLand Escort's portfolio, so generally there's greater income resilience because for longer stay accommodation, we will see a more steady flow of income. So from this sector, the pick will be for Capital Land Escort Trust. And for healthcare, okay, healthcare REIT will be concerned with a hospital as well as a nursing facility, medical centers, and elder care facility. So this sector is more defensive, not so dependent on the ups and downs of the economy, but rather perhaps a bit dependent on, say, the government development of the healthcare sector. So if a government is more pro-healthcare for the country, then it'll be beneficial for healthcare REIT. So there are only two healthcare REITs listed on the Singapore Exchange, Parkway Life REIT and First REIT. And the pick for this sector will be for Parkway Life REIT. They have 61 hospital and nursing homes. So the 3 hospitals are all in Singapore, which accounts for 65.3% of their portfolio. And they have nursing homes in Japan and 1 medical center in Malaysia. So all their properties in Japan are for nursing homes. So the sponsor for this Parkway Life REIT is a subsidiary of IHH Healthcare. And occupancy is almost at 100%. This is because the property are leased out actually to another company, subsidiary of IHH. Also meaning they're actually leasing out to their own internal companies. And for this reason, the portfolio yield is also very high at 16.8 years. Because they are signing contract with themselves. So the aggregate leverage is also very good, 36%. Interest cover is 11 times. And if you were to look at the cost of debt, it's only at 1.27%. So they managed to get a very good loan from the banks. Probably before COVID or before all this interest rate hike, they already locked in their loans. And then due to this very stable operating structure, so this REIT is also very popular for REIT investor looking for stability and safety, right? So for purchaser of this REIT, usually they will forego a bit of the dividend yield just to buy into this REIT. And what is interesting for Parkway Life REIT is that they own 3 very famous hospitals in Singapore. Glen Eagles, located next to Botanic Gardens and next to Napier MRT station. Mount E Hospital, just behind Lucky Plaza, very near to, quite near to Orchard MRT station. And then Parkway East Hospital, near Teruk area. So this is a collage of photos of the 3 hospitals, Glen Eagles, Parkway East Hospital, and Mount E. And for the nursing home in Japan, is very well distributed throughout the entire Japan. So all the way in the south, and then extend all the way to the north in Hokkaido. So for within this sector, the pick will be just for Parkway Life REIT. And then we come to the diversified sector. So by diversified, what it means that it's a combination of at least 2 sectors from the above 6. So the asset will span across multiple sectors, and the factors that affect this REIT will vary. And currently there are 11 REITs within this sector. CICT, Suntec, Lendlease, Fraser L&C, Mapletree Pan Asia, Ascendus, CCT, CIT, Cromwell, iREIT, and OUE. So for this sector, the pick will be for CICT, right? CICT has a 26 property, almost 94% are in Singapore, and only about 3.6 in Australia and 2.7 in Germany. And the assets are also well diversified. About 1/3 is in office, 1/3 is in retail, and another 1/3 is integrated development. The sponsor of this REIT is CapitaLand. Occupancy is 96%. Aggregate leverage just below 40%. Interest cover 3 times. Dividend yield is also reasonably good, 5.12%. And if you were to take a look at the assets within this property, we see they are very famous names. Or for example, Plaza Sing and the atrium just next to Plaza Sing, and then Funan Center, Raffles City. For the retail arm, we also see very famous names within the prime areas of Singapore, including Bugis Plus, Bugis Junction, Junction 8, Westgate, Tampines Mall, Bedok Mall IMM, and Lot 1. And for the office property, they are also located in very prime areas of the CBD or Asia Square Tower 2, Capital Green, Capital Tower. And very recently, just about 1 to 2 weeks ago, that CICT announced this very new addition to their portfolio, Ion Orchard. So as we know, Ion Orchard is located just above Orchard MRT station, or in the very, very prime area of the Orchard stretch. So this addition is a very strong mix into the portfolio of CICT. So for this sector, my pick will be for CICT. So in view of time, we will not. So I only pick one from the diversified sector, but actually there's quite a few other good REITs within this diversified sector, including Fraser LNC, as well as CapitaLand Ascendas. So this is a summary of the 8 REITs mentioned just now. Fraser Centrepoint Trust for retail, Keppel REIT for office, Mapletree Logistic, Mapletree Industrial, Keppel DC, CapitaLand Escort, Parkway Life REIT, and CICT. So one common thread that ties all these 8 REIT together will be the component of the Singapore property. So except for maybe Mapletree Logistic, because as we mentioned, Singapore, we don't have a lot of land to build a very big logistic facility. So we have to look elsewhere for our logistic properties. But other than that, generally we will prefer to have REITs that have a big component of their portfolio in Singapore. And besides building your own REIT portfolio by buying individual REIT, you can also consider buying the REIT ETFs. So the structure for REIT ETFs is quite similar to individual REITs. The difference is that for REIT ETF, the money will be used for purchase of a portfolio of REITs instead of buying into properties. And the role of the manager is also slightly different in that it's mainly to do a review and rebalancing of the REIT property. And presently, there are 5 REIT ETFs listed. Lion Phillip S-REIT, SESOP S-REIT, Lion APAC REIT ETF, UOB Green REIT, and Nikko AM Straits Asia. So for this 5 REIT ETF, only two are comprised of REIT listed on SGX or 100%. Also meaning for Lion Philippe S-REIT and for SESOP S-REIT, these are the only two ETFs where the component is made up 100% of REITs that are listed on SGX. And for the Philippe Asia Pacific REIT, this one is a portfolio of REIT listed in 3 exchanges. So through this ETF, you also get access to overseas listed REITs. And the UOB Green REIT, this is the only green thematic REIT, and you get access to 4 exchanges, to REITs listed in 4 exchanges. And for Nikko AM Straits Asia Asia REIT, this is the most diversified REIT ETF. Within the portfolio, you'll find REITs listed in more than 6 exchanges. Right. So currently, our company is running a campaign for clients who do not yet have a CFD account. So from now until 25th December, Christmas, if you open a CFD account, you will receive one contract of Palantir. So Palantir is doing very well in the market recently. Just about 2-3 nights ago, it surged by 14% within one session. And then if you are also already actively trading, you can consider opening a CFD account, then doing $1.5 million in trade. Then with this, you'll qualify for a TSM contract. And TSM is currently trading at around 162 US dollar. And if you're very active, you can try for the 3rd tier, where you get a Microsoft contract. And Microsoft is currently trading in the market at about 400 US dollar. And if you do not yet have a Phillip account, we hope you'll come on board. Please scan the QR code to open your Phillip account. So I will show this again later. So for now, we are nearing the end of the session. So we'll do a Q&A, and then I will do a summary of what we mentioned during the webinar. All right, so in the meantime, as you type your question, I will show the QR code so you can scan for account opening. And let me just look at the question first. All right, so I will answer the questions currently. So the one question is on the property WALE, WALE, weighted average lease expiry. Okay, what is the healthy range for property WALE? So for a WALE, right, it could be double-edged. So we don't want it to be too long or too short. Okay, the reason is because a long WALE will provide stability, but it does not allow for negotiation of the renter, usually unless it's included within the lease. But otherwise, a negotiation or reversal of the renter can only take place when the current tenancy expires. So a short WALE doesn't mean it's a bad thing, because a short WALE during a good economy, it can allow the REIT more opportunity to raise the rent. So okay, to answer the question, there's no fixed number. So it depends on your what you're looking for. Are you looking for stability? Okay, in which case you go for the REIT with longer yield, but then you forego opportunity for possibly more frequent rental reversion. But if you are looking more for growth, okay, then you may, and if the environment is positive, meaning no recession, the outlook is looking well, you can try to go for REIT with shorter WALE, because as the lease expire, then there's a space to negotiate for higher rental. Right. So, no, okay, the other question. Okay, for the top 8 REIT picks, what is the debt maturity profile? Okay, so for the 8 REIT picks, I have show the debt maturity profile individually during the run through. But generally, let me just do a quick run through as well, since we are looking at them now. So we start from retail. Okay, so the weighted average debt maturity for Fraser is 2.8 years. And for Keppel REIT, it is 3 years. For Mapletree, 3.7 and 3.6. For Keppel DC, 3.1. For CapitaLand Escort, 3.6 years, not percentage, 3.6 years. And for Parkway Life REIT, 3.4. For CICT, 3.5. Yeah. So for the 8 REITs, yeah, it's in the range of about 2 point something years to 3 point something, which is quite normal. I mean, it doesn't mean it's good or bad, because as we mentioned, it's also sometime dependent on the timing. So if the rates are coming down, and if you manage to have the loan expiring at a time when rates are low, then the REIT will benefit. All right. Yeah, I don't see any other questions at the moment. So, yeah, let me just do a quick summary of the session, and then we'll wrap up. Right. Okay. So to summarize the session, why we are looking at S-REIT at this point in time is because interest rates are expected to trend down in the coming quarters. And also, in the last few months, we are seeing a sector rotation. So we are seeing the very growth focus sectors such as AI stocks, tech stocks, Magnificent Seven. These are all sold down in favor of more income yielding vehicles such as bonds or financial stocks or REITs. So we believe this could be a sustainable trend, maybe not a big rotation, but then it will provide support for REIT market in general. Because there's a worry that the tech stock, the AI stocks are too expensive. And then and another factor for S-REIT is that S-REIT offers a very good dividend yield of 5 to 8% for very low volatility. And another reason is because of the faith in the Singapore government, usually very supportive for S-REITs. And then generally REITs with properties in Singapore will be preferred due to probably the environment of Singapore properties, or all the laws, rules and regulation that the property sector need to comply with. So all this make the Singapore property very safe and very supportive of continued sustainable growth. And then if you want to buy REIT, you can build your own portfolio, or you can also diversify by just buying a REIT ETF. All right. Okay, so with that, we have come to the end of the session, of this 1 hour session. So if you need to contact us, here's our contact details. Right. And with that, we will end the session. Okay, thank you for your support, and we hope you continue trading here with Phillip Securities. We hope to see you again in our coming sessions. Right, Vanessa, can you help to take over?